In this video, I'm going to share with you a smart and effective way to grow your wealth that is becoming increasingly popular in Nigeria, and that is mutual funds. So what are mutual funds and why are they important for growing your money? So let's dive right into this and find out. Mutual funds are essentially a pool of money collected from many investors to invest in a diversified portfolio of assets such as stocks, bonds, or money market instruments. This means that even if you have a small amount of money, you can invest in a wide range of securities and reduce your overall risk. In Nigeria, mutual funds are gaining traction, and there's a good reason for that. With growing awareness and understanding of these investment vehicles, more Nigerians are considering them as a viable option to grow their wealth. According to data from the Securities and Exchange Commission, SEC, the Nigerian mutual fund market grew by 29.6% in just the first 5 months of 2024. The net asset value rose from 2.26 trillion naira to 2.9 trillion naira. This growth is driven by both the retail and institutional investors looking for safer investment alternatives, especially in our often unpredictable economy. So whether you are a newbie in the investment world or looking for ways to diversify your portfolio, mutual funds could be a great place to start. Before we continue watching, I want to be very clear that this video is not sponsored by any of the companies I'm going to mention. I am sharing this information purely for educational purposes to help you understand how you can potentially grow your wealth through mutual funds. My goal is simply to raise awareness about this investment option that many Nigerians might not be fully familiar with. So let's start with the basics. What exactly are mutual funds and how do they work? Imagine you and a group of friends each put a small amount of money together. This pooled money is then invested in a variety of things like stocks, bonds, or even real estate. By pulling money together, you can afford to buy a wider range of investments than you could on your own. Each of you owns shares in the mutual funds, which represents a portion of its holdings. These investments are not managed by you or your friends, but by professional fund managers. Think of them as financial chefs. They choose the right mix of ingredients, which are investments, to create a delicious meal, which are returns. They analyze market trends, economic data, and company performance to make informed decisions about where to invest. Their goal is to achieve the best possible returns for the fund's investors while managing risk according to the fund's investment objectives. For instance, Stanbic IBTC Asset Management, a leading mutual fund provider in Nigeria, offers various funds tailored to different investment objectives, including conservative, balanced, and aggressive growth options. Other prominent players in the Nigerian mutual funds market include FBN Quest Asset Management, ARM Investment Managers, United Capital Asset Management, and what used to be Zenith Asset Management, which is now Quantum Zenith Capital. Each offers diverse investment products to meet varying investor needs and risk appetites. By investing in mutual funds like this, you are effectively buying a piece of a larger, well-managed portfolio. This allows you to benefit from the fund manager's expertise and the fund's diversified investment approach without needing to manage it all by yourself. Now, let's explore the main types of mutual funds that you can invest in here in Nigeria. Understanding the differences will help you choose the best option based on your financial goals and risk tolerance. Let's start with equity funds. These funds primarily invest in stocks. They are ideal for investors who are looking for higher returns and are willing to accept more risk. Stocks can be volatile, but they also have the potential for significant growth over time. For example, the Future View Equity Fund was one of the top performers last year, delivering an impressive 86.02% in returns. If you are looking to invest for the long term and don't mind the ups and downs of the stock market, equity funds could be a good fit for you. Next, we have money market funds. These funds invest in short-term, low-risk financial instruments such as treasury bills and commercial papers. They are perfect for conservative investors who prefer safety and liquidity over high returns. The average yield on money market funds as of May 2024 was about 17.19%, with top performers like Emerging Africa Money Market Fund offering yields up to 20.96%. Money market funds are a great choice if you want to park your money in a safe place while still earning some interest on it. The third type we'll discuss is bond funds. These funds invest in bonds and other fixed income securities. They offer regular income with moderate risk, making them suitable for investors who want a steady return without taking too much risk. The Stanbic IBTC Conservative Fund, which focuses on bonds, delivered a solid 24.6% returns last year, demonstrating steady performance in the fixed income category. Bond funds can be an excellent choice if you are looking for stable, regular income rather than high-risk, high-reward investments. Each type of mutual fund has its benefits and risk levels, so it's essential to choose based on your financial goals and risk tolerance. Whether you are saving for retirement, building an emergency fund, or looking to grow your wealth over time, there's a mutual fund out there that can help you achieve your goals. Now, let's talk about the benefits of investing in mutual funds. Why should you consider adding them to your investment portfolio? To begin with, one of the most significant benefits is diversification. By investing in a mutual fund, you are spreading your money across a variety of assets. This reduces your risk because if one investment doesn't perform well, others in the portfolio may help balance out the overall return. For example, if you invest in a fund that holds both stocks and bonds, a decline in stock prices might be offset by gains in bond prices. Another important advantage is professional management. Like I said earlier on in the video, mutual funds are managed by professional fund managers who have the expertise to make informed investment decisions. They conduct thorough research, analyze data, and monitor the market to ensure the fund's assets are well positioned to achieve its investment goals. This is particularly useful if you don't have the time, knowledge, or desire to manage investments by yourself. With a mutual fund, you can rest easily knowing that your money is in the hands of experienced professionals. The third major benefit is the low starting amount required. You don't need a lot of money to start investing in mutual funds. Most mutual funds in Nigeria have a low minimum investment requirement. For instance, you can start investing in the AXA Mansard Money Market Fund with as little as 2,000 naira. This makes mutual funds accessible to almost anyone who wants to start investing, regardless of how much money they have. So how do you get started with mutual funds? Here is a simple guide to help you begin. First, you need to research the funds. Before you start investing, it's essential to do your homework. Look up different mutual funds and their performance histories. Websites like the Nigerian Exchange Group offer a comprehensive list of mutual funds available to Nigerian investors. Pay attention to each fund's objective, past performance, fees, and the types of assets it invests in. Second, choose a mutual fund provider. You will need to select a reputable mutual fund provider. Some of the top providers in Nigeria include Stanbic IBTC, FBN Quest, and ARM, to mention a few. When selecting a provider, consider their fund performance, fees, customer service reputation, and the range of funds they offer. For example, FBN Quest Asset Management, a subsidiary of First Bank, offers a variety of funds, including the FBN Money Market Fund, which had a yield of 12.15% in early 2024. The third step is to open an account. Opening an account is usually straightforward. You can visit the provider's website or their physical office to get started. You will need to fill out some forms, provide necessary identification documents, and sometimes complete a risk asset questionnaire. This process helps the provider understand your risk tolerance and investment goals to recommend suitable funds. Fourth, make your investment. Once your account is set up, it's time to make your investment. Decide on the amount you wish to invest. Most providers have a minimum amount requirement, such as 5,000 naira for the Stanbic IBTC Money Market Fund, for example. Ensure you are comfortable with the amount and it aligns with your financial goals. Finally, monitor your investments. After investing, it's crucial to keep an eye on your funds. Regularly check the performance of your investments to ensure they are meeting your expectations. Most providers offer online platforms or mobile apps to track your investments easily. Staying informed will help you make better decisions and adjust your investment strategy if needed. To wrap up, as we can see, mutual funds are a great way for Nigerians to grow their money. They let you invest in different things at the same time, like stocks and bonds, with the help of professional managers. This means you don't need a lot of money to get started. You can start with what you have and earn good returns. If you're not sure how to manage your investments, mutual funds can be a smart choice because experts handle everything for you. But remember, like any investment, it's important to do your homework. Check out the different funds, understand the risk, and choose one that matches your goals. It's also important to note that the earlier you invest, the more money you can grow over time. Thanks for watching. If you liked this video, please give it a thumbs up, share it, and subscribe for more tips on managing your money. See you in the next one. Bye for now.